Hello everyone, my name is Phil Seymour, Company President at IBA. Thanks for joining us today. Welcome to our webinar entitled How to Build Resilient Engine Management Programs for the Road to Recovery. To do that, we'll first look at some of the key indicators regarding the aircraft and engine status, especially those that drive shop visits. Plus, we'll have some debate and discussion around the options facing engine operators and owners at the moment. So I'm pleased to welcome our experienced panel. I'm joined by Mal Cowley, IBA's Business Development Manager based in Dublin, and David Archer, Senior Analyst Engines. And before I start, I know Mal doesn't really want me to mention this, but we first met in 1986. So that's 34 years ago. I think we were in our late teens or early 20s. I was the engine guy at Down Air Tech Services looking after the JT8 engines and APUs, and Mal was Customer Support Manager at Air Motive Ireland. Mal, it only seems like yesterday, doesn't it? You don't have to answer that. But I think we might have been a bit older than 20. But anyway, today we're going to be sharing our view of the engine market and how that is affecting shop visits. As a reminder, we designed these sessions to consist of around 45 to 50 minutes of opinion and analysis, with the remainder to address questions. Thanks to those of you who've submitted questions already. We will be taking more questions during the webinar, so please do ping them over via the questions link on your control panel, and we'll look to address them where we can. Looking at the numbers, we have around 750 registrants. Half of those are from the leasing and finance community, with the other half split into airlines, OEM, MRO, and a few legal and accounting folk. So this slide is really showing a very brief picture of our 30 years of aviation experience, where we really look to maximise opportunities and minimise risk across the aviation assets. And it's through our advisory, aircraft and engine valuations, practical asset management and tech services, as well as the providing data intelligence through our platform, Insight IQ. And there's a lot of data we're providing you today with that. If we could have the next slide before we get into the main heart of the content. This is a plea for votes. We were Appraiser of the Year 2020. We know that 2020 is a year we don't really want to remember, but we do remember it as being Appraiser of the Year 2020 at IBA, and we would really like to be able to perhaps get rid of that award in an environmentally friendly way and replace it with the award for 2021. So in the pack that you receive during the course of tomorrow, the Vote Now button on this slide will take you straight to the link. So would appreciate your support there. Before we go into the main deck, I've got a polling question coming up, which is just to get a feel of the attendees we have today. So looking ahead to 2021, do you expect to see at your company more interest in the engine market, less interest in the engine market, or same interest as the pre-COVID period? If we could just have your votes on that, that will be appreciated. Thank you. And give you a few seconds. And okay, well that's interesting. I think generally we are getting a lot of questions about the engine market, and it's not just from our usual clientele who are already in the sector. And I think the numbers today that we have show that there's a lot of interest in the engine market, and we're obviously going to discuss why that is. But we do see this as a very important time for the engine sector. So I think that's enough from me. I'm going to hand over to David Archer at this stage. Oh, sorry, I think I'm doing this one. Sorry, apologies. I am going to just set the scene at the aircraft level. Really, the heavy red line here is at the 12-year stage, and what we're seeing is that is a key decision year for a lot of aircraft. Obviously, it coincides with a lot of the Airbus heavy maintenance programs, and we are looking at a number of aircraft that have been stored in this category, and the decision is whether those aircraft will just face retirement in the medium, well, basically be retired, or whether they'll be coming back into the fleets. But as you can see, there's a significant number of aircraft that we would normally expect to perhaps retire once they're over 20 years old. But there's a lot of questions now being asked about the impact that this pandemic is having and whether some of the aircraft that are currently stored will actually come back into service. And it's now at this point that I hand over to David Archer.
Lovely, thank you, Phil. So to begin with, I'm getting a little bit of feedback. To begin with, I'll start with just an overview of the population of engines as we're seeing on an aircraft by aircraft basis, currently parked and stored. It gives you an idea of where the focus of our interest is in terms of concerns around potential future demand, current utilization levels, all having a knock-on effect on shop visit demand. Starting here, obviously looking at the 737 and A320 families as a focus, and within those you can see on the A320 side at least a breakdown of the engine types that we're seeing currently parked. But I just wanted to touch on these at a high level. If we move to the next slide, we can see the same again for the wide body market, a bit more of a mix of engines in there. Really what you're seeing in terms of the peaks, the highest numbers are typically the largest fleets. But obviously the quad engine aircraft will be an area of concern for many. And we're looking here largely at some maturing fleets. Now some have seen support from freighter markets, but overall this is kind of a quick look, quick snapshot of where the focus is in terms of the current stored and parked fleet on an engine by engine breakdown. If we move to the next slide. So high level trends on the engine market. So what are we seeing? The first big change really since our last webinar is the introduction of the vaccine. Obviously in the UK we've had the first inoculation. Now this isn't a silver bullet, we're not going to see a sudden change in the market, but it is an optimistic sign, a good sign ahead. In terms of passenger demand coming back, I mean, we have said for some time that 3 to 5 year frame, and perhaps this is kind of that first step in that direction. Trading volume, we speak with lessors regularly, and the feedback really hasn't changed much. If there is a good deal out there, it will be had. Large discounts largely required. Sale and leaseback opportunities are there. There are airlines who are looking to release cash from assets, and there are lessors who are looking particularly at the latest generation of engines, on the Neo and on the Max as well, looking at those engines as potentials, and we are seeing potentially that market getting a little bit healthier, seeing healthier lease rate factors being achieved than actually with pre-COVID. So again, some positive signs there. We're also seeing some signs of opportunistic deals. This is more around the slightly higher risk, more mature assets. You're looking at typically smaller lessors who are willing to take on that higher degree of risk. And there is some room around there. Clearly, if an engine comes to the market at the right price, there will be bidders currently. But largely, the volume is heavily decreased from previous years. Freighter market continues to provide resilience for some engines that we would typically expect to see softening heavily. We've noted there the Pratt & Whitney 4000 and CF6, so on the 767 largely being the focus for that, and those actually being fairly buoyant throughout all this. And as you can imagine, all this leads to value softening and lease rate softening. Lease rates that we're seeing at the moment are typically around short-term leasing. We aren't seeing that many long-term leases being negotiated right now, and the values are very soft compared to what we would have seen at the end of 2019 as an example. If we can move on to the next slide. So how is each sector being affected? We touched on this in September, but I think it's worth revisiting this. So the lessors we've touched on, they are seeing an increased number of engines coming back off lease, some of them not being renewed, and some of them are becoming parked. Typically, it's still a smaller percentage of their overall fleet. We're not seeing half of a lessor's fleet being parked, but it is a noteworthy percentage of the majority of lessors that we're dealing with. Again, their focus is primarily on sale and leaseback of new engine technologies. Many will have boards that will refuse to sign off of more mature assets and without very significant discounting. Again, that maintenance avoidance is ongoing since really the summer, unless their hand is forced or unless it's an end of lease inspection. We're really not seeing these engines go anywhere near a shop if they don't have to. In terms of the MROs, I think we're past the point now of cutbacks. We're at that bottom point. The consensus seems to be a reduction to around 50% of the shop visit demand that we were seeing historically. So obviously they had to, earlier in the year, lead to a lot of redundancies, unfortunately, but that seems to be kind of bottoming out and a more positive future hopefully ahead. Of the shop visits that we are seeing, that 50% though, it's worth noting that whether we're talking to MROs or OEMs, there's a pretty consistent theme that many of these shop visits are for lighter scopes. So you can see that theme of lessors and owners trying to invest as little as possible in the maintenance where they can. Obviously, the knock-on effect of that is reduced demand for used serviceable material, reduced demand for teardowns, but still long-term, there are very good signs for the future of this market, and we'll touch on this later. But whilst shop visit demand for engines is very far down right now, there's potential for higher peaks in the future because of that compounding effect of so many shop visits having to be delayed. And finally, OEMs, really the story here, other than production being lowered, has been the retrofitting and retroactive actions they've taken to rectify issues on some of their newer engines. So the Leaps, the GTS, the Trent 1000s, all are seeing a lot of the teething issues that we've had for quite some time now being rectified. We're seeing massively reduced AOG events, and really it looks to be that 2021 will be the year that a lot of these issues will become a thing of the past, which is an excellent sign. If we move on to the next slide, please. So this is a chart some of you may be familiar with. We have provided this previously. Two things to point out first. The blue area line at the back, that is 2019. This is our forecast of shop visit demand on an engine-by-engine basis. And that dotted line is where we were at 2019, so around about 6,000 shop visit events. And we're comparing that to our projections and to our now 3 scenarios for potential post-COVID recovery. We've gone from a top view, or that view 1, where we're looking at around 50% reduction, which is roughly where we come out to, down to view 3, which is a much more severe reduction. And the factors that we take into account to produce these, firstly, how steep was that shop visit demand? So obviously we now know we're looking at around about 50%, perhaps a little bit lower, depending on the makeup of lighter scope shop visits. In terms of the demand for MRO capacity, time for recovery, so how quickly will we recover to the utilization levels that we saw in 2019? Capacity recovery, so how quickly will these MROs be able to accelerate their capacity to meet the demand? And lastly is how many of these shop visits will actually not come to fruition? Obviously, the worse the view we take, the more impact it can have on these shop visits being offset and not becoming a reality. And if we go to the next slide, we can look at where we think that will be focused. So again, these are all pre-COVID projections, but some of these trends will remain consistent. This left chart is breaking down what the aircraft class is. So narrow body, our projections were obviously for an increasingly large proportion of the aircraft fleet being narrow body. Regional, a kind of the smallest size, with wide body maintaining a fairly similar size but a diminishing percentage. And then second, if we move to this chart on the right, we're looking at what stage of life the engine is. So whether it's a first run engine in that blue, second run in that darker green, or third run in the lightest green. And really the combination that seems the highest risk will be a mature wide body engine. And we have seen the freighter market support this, but if we're looking at the likes of the 747 fleet, that's a prime example where there's a lot of risk around the future of those assets, really not very much demand there. Whereas if you're looking at the majority of the narrow body fleet, much of that, particularly from CFM as an example, is yet to go through this first run of the shop visit, let alone Leaps or GTF engines. Those are the engines where we see the most strength, most resilience, and we have the most confidence in going forwards. Really, it's the question will remain around, is it a third run engine? That's going to be a question, and whether or not it's going to be one of the younger or potentially more mature wide bodies, and somewhat the earlier narrow body aircraft as well. If we move on to the next slide. As an example here, just to show how engine values behave over time compared to aircraft values. Now these lines match fairly closely with our base value projections that we would provide at the introduction of these platforms. But what we're seeing is over time, as the value of the aircraft as a whole has diminished, the engine value has remained fairly resilient. Now it has obviously been a very strong market for some time, but we can see at this tail end here, we have our latest valuations. They're as of July, but we haven't changed them since. We are seeing a softening in engine values, but that's focused much more on the aircraft as a whole, and just shows the resilience and the focus that should be placed on the engines as a contributor of value to the asset. And I believe on the next slide, I hand back over to Phil.
Thanks, David. Because we've just touched on values, I think this is important that we do mention impairment. As we say here, we are not accountants, but we do know that our data is being used in these assessments. And I think in terms of us understanding the objective of where our data is being used, I think it's important, because I still think there's a lot of questions that even the auditors probably don't know the answers to, and some of the airline clients in particular have been asking some pretty tough questions. If I stick first with IFRS 36, and like I say, we're not accountants. I'm not an accountant. This has been around for years, and this is really all about any asset that is owned needs to be assessed on the basis of either its fair value less cost of sale or its value in use. So for an airline that owns spare engines, this will generally mean a valuation on a fair value less cost of sale basis. And I say we do get asked this every year, really, across aircraft, spare engines, and in fact spare parts inventories. For a lessor, it's probably I say relatively easy, because they will be looking at it from a point of view of the engine's value in use, and there's probably only a couple of metrics they have to worry about. It's the cash coming in for the rental, and they may include some element of the maintenance reserves for that as well. Obviously, if a lessor has an engine off lease, then it will need to look at it on a fair value less cost of sale basis. Now, there are differences. US GAAP is different to IFRS, so this is very much depends on which jurisdiction the company is in. So, like I say, IFRS 36, I think we're relatively comfortable with. There's a lot more questions this year around IFRS 16 or IAS 16, which is really all about the leased assets and their right of use. So for me, as an engineer by trade, this is something where I do understand that in the past there's been a lot of what we would call off balance sheet financing, where there could be huge obligations for exposure to long-term lease costs, which have not been on the balance sheet. So IFRS 16 was devised to make sure that those liabilities were captured, but at the same time balancing the fact that there was a right of use that was benefiting the airline or the lessor. And so in this case, an airline that leases spare engines, and IFRS 16 addresses leases of more than 12 months, then it's very likely that IFRS 16 is going to be applicable. As I say, there is a balance between what is seen as the right of use that is enabled by the lease, but also there's an impact on depreciation and liability interest that has to be calculated. So what this means generally across the airline industry, the very sort of top level view of IFRS 16 is that it can impact the debt in the business by maybe 50%. It's obviously just very general numbers. However, the EBITDA can actually improve because all of the costs associated with the depreciation and interest are, of course, EBITDA, earnings before interest, tax, depreciation. So there are some potential things going on there with the accounts that mean we're being asked a lot of questions about typical lease rates for engines and aircraft, particularly the longer term ones, and whether those lease rates are current or mark to market. So in a down cycle, as we're obviously in, across both aircraft and engines, we can see an impact on the rate that was agreed a year ago. And if you've leased that asset for 5 years, you've still got to pay that lease rate. It may not be at market level. So I think here, just to give you some typical illustrative changes from last year on this engine type. We've seen a pre-COVID, 5.34 million and a post-COVID 4.45 million on market value. So that might be the sort of numbers we're seeing on an IFRS 36 basis. And then the longer term lease rates pre-COVID were at 60 to 70,000. I say post-COVID, I hope we're post-COVID, maybe we're mid-COVID, 40 to 60, although we do our mark-to-market lease term for engine leases is around about 3 to 5 years. So some of the lower rates we're seeing, excuse me, are because of their short-term leases. I hope I haven't sent everybody to sleep on this slide, but we do think it's something really important. So let's head down into the detail of spare engines. Over to you, Mal.
Yeah, I think the discussion here is, to complete the impact of values and shop visit events and everything, you've got to look at spare engine levels in the market and what typically drives the spare engine level. And historically, spare engine levels were driven by, supply. They drove supply in the market. But historically, operators would keep 10 to 12%. If an engine is very mature, you may see that drop, but that depends on reliability. So for the CFM 56-7, for example, we were seeing spare engine levels down as low as 5 or 6% at points in time because of the high reliability and the long time on wing. In contrast to that, if you look at the spare engine levels for the entry into service engines, more recently, they were much higher and certainly well north of 15 to 20% in some cases. But that's temporary, and in the environment we're seeing today, with the number of parked aircraft that David showed us earlier, and the spare engines that are available off those aircraft, we're in a changing environment. So, at mid-cycle, we would have had a stable position. COVID has really thrown that askew to some extent for certain engine types, but again, as David pointed out earlier, not for every engine type, because there are always in this market, there are always niche types that ride out the storm differently. That said, when you look at the long-term position on engines, and at IBA we tend to look at take a long-term view of these things as well. The long-term position is that engines do hold their value, and they're fairly resilient in value terms over time. So there's a lot of opportunities out there. Operators will tend to, want to see good lease terms to avoid the heavier capital cost and heavier capital investment in spare engines. And while we may be seeing a temporary stop in that demand, it will come back once utilization comes back. On the newer engine types, the final point there really is that the OEMs have in recent times dominated the new engine leasing market. But that may change, and again, good sale leaseback opportunities for operators may, or in fact we would project will see a recovery in that. The discussion is really complete when you also look at what's happening post-COVID. And I think if we can have the next slide there, please.
Mal, while that slide's coming up, can I just ask you, the spare engines, when there's entry into service problems, I mean, presumably it's down to the OEM under warranties and product support to maybe feed more spare engines into the airlines. What happens over time? Do they, when the situation gets better, do they sell those engines or do they keep hold of them? Is there something general, or is it too specific to?
No, I think it's a fair point, Phil. I think over time, I mean, we certainly saw on some of the narrow body spares, there was very high percentages in the OEM lease pools in the past 12 months. Those percentages will decline for two reasons. One, as the reliability improves and stabilizes, that, you know, the spare engine level, the number will stay the same, but the fleet will increase, so the percentage decreases. And then to take your point, of course, yes, there'll be sale opportunities there for others in the business to take ownership of those engines and do their own short-term, medium-term, and long-term deals on engines. So that's
Okay.
the way we would expect to see that in that market developing over time. But
Okay.
yeah, and you know, just we're going to move on and talk about shop visits in a moment. But the need for spares is driven by the fact that your engine is off wing and it has to go into the shop. So if MRO activity is down, the demand is down. And with our IQ Insight platform, we track a lot of these parameters very closely. And one of the things we've noticed on this slide is that the global flight hour to flight cycle ratio is declining a little bit, is showing a reduction. Now, we understand there's lots of reasons behind that: ferry flights, reduction in the inclusive tour market, which would typically be longer sectors. But it is a pattern we're looking to, and I think that, you know, we will continue to monitor that over time and see how these flight hour flight cycle ratios pan out going forward, because they do drive shop visit levels, and they do drive that in turn drives spare engine levels. Perhaps Phil, you want to comment on the chart on the right hand side there about the increasing cost per hour ratios?
Yeah, well, I think this is important. Firstly, obviously, I suppose the engines, particularly the high cost sections of an engine, the hot section combustor, it's really all about the cycles. You know, if you've got an engine on long sector lengths, then generally speaking, your hourly cost is going to be better than an engine on the shorter sectors. So I think with that in mind, obviously this becomes an inverse of the graph on the left. So as you're starting to see decreasing hour to cycle ratios, you're seeing an increasing cost per hour. And I think the reason this becomes very relevant is that not just for the engine leasing cost, but even at the aircraft level, there's usually a matrix within the lease that refers to, you know, what the expected hour to cycle ratio was, and then throughout the lease, an annual review of where that has been over the last year. So there can be some significant changes in that cost per hour. This graph on the left is, the graph on the right is purely illustrative. We haven't given you the exact numbers there, but obviously it would depend on the severity curve in terms of, you know, where engines are operated. As we've seen in the past with some engine types, the region is very important. Hot and high locations. We saw some specific high cost issues with engines operated in the Indian subcontinent and some of the tough areas in China, for example. And that you can almost see the cost per hour almost doubling compared to a relatively benign environment such as Northern Europe or some regions of the USA. So, but obviously this is something which is important. We like to track this because the engine maintenance cost is a significant cost for the airline. You know, some airlines will capitalize it, some will see it as expense, but you know, the whole engine MRO sector is obviously worth, you know, many billions of dollars, and that's probably why we're talking today, both from the MRO perspective and the leasing perspective. So the next slide is really, excuse my throat. So time on wing, I put this out as a bit of a challenge, really, because is it true that the longer an engine stays on wing, the better? I mean, we have, the last 20 years at least, we have been informed by the OEMs that the longer the engine stays on wing, the better, because it gives you the best economics. Obviously, if you've got an engine that's at a high build standard, so a new engine, when that engine goes into the shop for that first shop visit, there is a choice on work scope. That generally speaking, the higher the build standard, so the more new equipment that goes in, the more new parts, and all the modules are overhauled to the best possible tolerances, will give you a longer time on wing, which will in turn will give you the lowest cost per hour per cycle. That, of course, is the concept behind a lot of the long-term OEM aftermarket contracts. You know, the alignment of interest, the fact that, you know, the airline pays the OEM for that long-term support, and the OEM not just takes care of the shop visit, but also the risk is transferred from the operator to the OEM. So I think this all sounds very logical and a great way to do things. I suppose the question I pose is that valid in today's market? When cash is king, do you really want to build an engine to the highest possible standard? Would it be the case that reducing or optimizing the work scope, perhaps at the expense of time on wing, and the adverse long-term economics is considered, but that reduces the short-term cash for the operator? And I think that if I go back to all those 34 years ago, I was really going to put it to Mal that, you know, I was working for an airline. We had a budget for the engine overhauls, and I won't overcomplicate things by saying it was slightly different in those days, because it was more of a hard time regime rather than on condition. So we sort of knew when these engines would come off. But I suppose I'd be saying to you, Mal, with your sort of engine shop manager's hat on, can you help out? You know, we had a budget of 3 million for this shop visit, Mal. We're really struggling. Every dollar counts. I don't want you to do just a minor repair. I do want to get a reasonable build, but perhaps instead of an engine that's going to last for 8,000 hours, can you build one for 4,000 hours at, you know, 60% of that 3 million? How would you know, tell me I can do it, please, because we need these dollars, Mal. We need these dollars in our airline.
Well, absolutely, Phil. I think from an MRO perspective, what they've got to, you know, and they will take into account, is that the operators have options here. Because we're in post-COVID, there's a lot of parked aircraft. They can look at exchange engines, for example, instead of, you know, putting an engine into a shop. They can look at medium long-term leases. They'll get good deals where there's a surplus in the market. And, you know, that really is a consideration that MROs will take into account. And yes, it goes against the, you know, the niceties, the economic niceties of getting the lowest cost per hour. But if your operating window on a particular aircraft type isn't, you know, 15, 20 years, if it's shorter, you'll take all those things into account. And I, for one, would think that in the current cycle, a lot of operators are going to be very actively looking at that and looking at what other aspects of their lease agreements and whatever other agreements they have need to be taken account of in that estimation.
Yeah, it obviously is there's a lot of considerations here, because I can imagine that would be a really tough conversation with, you know, if I've been paying one of the big OEMs under, you know, a long-term care type agreement, without giving names away, you know, they've got the cash, haven't they? I'm not sitting with the cash. I'm not saying, can you spend less? So then they're not really going to give any cash back to the airline, are they? In that situation, they will still want to build it to the, you know, 8,000 hour standard, not the 4,000 hour standard.
That's probably the case, but there's also a lot of deals out there nowadays which are pay as you go, which they're effectively a guaranteed rate per hour, and you know the cash isn't held by the OEM. So there's also those situations to take account of as well. But yeah, I mean, for certain aircraft types, building the optimum engine does make sense. If it's a very reliable engine and you're going to get, you know, especially on some of the wide body engines, you're going to see, you know, 25,000–30,000 hours out there on an engine build, and you have a long-term view of the aircraft, yes, that's something you're going to take into account. And you work with the OEM in that case. And indeed, I think the OEMs will actively work with all the operators in these matters. Yeah,
and I think the last bullet point on here is about lessors unlikely to want to accept a sort of a non-standard or variance from what's defined in the lease document. Very often there's a qualifying shop visit, and it will refer to all modules to a particular build standard per the work scope planning guide, and it does become quite a hurdle to get over in order to get the maintenance reserves back. So I expect there must be lots of conversations going on around that right now, and likewise, lessors may prefer to keep hold of some of that cash themselves, because there may be only, if this is part of a lease return conversation where the redelivery condition is that the engine has to be built for 8,000 hours or maybe even 8,000 cycles or something, and then what benefit is there to the lessor in doing that? They might as well keep hold of the cash. Is that are those the conversations on the streets of Dublin at the moment, Mal?
Well, I think not just Dublin. I think they're the conversations everywhere. And yes, it's a very active conversation, because, as you say, if the lease return demands an overhaul or refurbishment, performance restoration, call it what you like, and that's going to cost X $1 million, and there's reserves there, the lessor will take a view on that, because the engine shop visit, you will be absolutely, give you a restored engine, but you've got to look at the future marketability of that engine, and where its value will sit in the next 5–10 years. Because if you're building an engine for that lengthy period of time, you want to be sure you've got value retention in there as well.
Okay. It does remind me of just an anecdotal thing of, I remember one of my first telling offs when I was at Dan Air was spending an awful lot of money on an engine overhaul, only for it to ingest a seagull on its first flight out of Gatwick. There was me, I'd sent I don't know if we called them spreadsheets in those days. It was probably lots of typed words from the typing pool, where I'd convinced the management that we should really do a great shop visit, fully, let's gold plate this engine, because I trust Mal Cowley at that Airmotive Ireland to deliver an excellent engine. But unfortunately, you can't stop birds flying down the front of engines. But anyway, yeah, let's move on to the next slide, please. So this is really a continuation, and perhaps for some of those of you who are less into the whole purpose of engine refurbishment, I mean, basically, the basic reasons for a scheduled shop visit will either be a performance restoration, which basically delivers what it says on the tin. It restores the EGT margin and the specific fuel consumption. So it's a very important part, and most of this is about gas path. It's refurbishing or replacing the rotating compressor blades, the rotating turbine blades, and also replacing some of the stators, checking on the casing to make sure that it's not losing its shape, and that all of those tolerances are giving a really efficient low loss of pressure through the compressor. And likewise at the turbine end, that it's extracting the maximum amount of energy as the gas passes through the turbine. So really this is let's say an introductory guide. If we look at EGT on the red line, I mean, basically in order to get the right amount of power from the engine to achieve the takeoff, over time, because of the wear and tear within that gas path, you'll end up with needing to put more fuel into the engine to get the compressor efficiency up. and the turbine efficiency as well. So you end up putting more fuel into the engine. Obviously, by putting more fuel into the engine, your EGT margin, the green line, the difference between your actual EGT and the maximum EGT is declining. Every takeoff will have a little bit of wear and tear added, making the engine less efficient. And of course, that increases the fuel consumption. Basically, if you're putting more fuel into the engine to get the power, you're burning more fuel. So I didn't spend too long on the other reason for scheduled shop visits is, of course, life limited parts replacement, which are generally the high-speed rotating discs, which have a fixed life. So I think as far as this slide goes, we're just showing that over time you're going to lose your fuel efficiency. You'll get increasing fuel consumption. Actually, Mal, I will ask you on this because I hadn't realised at the time. I must admit, it took me a few years to get my head into those engine work scopes. But actually, not necessarily every single act, but if you go through a work scope planning guide, very typically it will show you that by replacing an old part with a new part, it will actually give you almost the exact EGT improvement and SFC improvement. At least the CFM products. Yeah. Is that there across all engine types? Do you see that?
Oh, it is, Phil, and I think it's one of the factors that isn't really taken full account of, but because all those little incremental benefits in EGT and incremental benefits in fuel consumption, can bring you back not quite to the new engine standard, but very close to it. So you have a much more fuel efficient engine, you're burning less fuel. And, I've been always puzzled in the business that there isn't as much focus on this as there would be, say, on the fuel savings and benefits that are introduced by new equipment. But I guess that's marketing. And I think that this can be considerable. And when you add up all those benefits, yeah, an airline might want heavy time on wing and long time on wing, I should say, really, and they're doing well on a cost per hour basis. But there is a penalty there. They're paying for it in more fuel consumption, and I don't think that's under question. And the OEMs will, and indeed aircraft OEMs will be able to demonstrate that quite comprehensively.
Yeah, thanks for that. So I think if we move on to the next slide, but that's 16. I think I was going to have a polling question after this one. In terms of shop visits, do you expect we will see an increasing trend to full refurbishment, increasing trend to repairs, or a move towards used material? You can only choose one, unfortunately, because you could potentially say, well, I really want to press B or C, B and C, but it'd just be good to see whether anything we've said has influenced you in any way, or whether you can see that there's going to be some changes on the horizon, or just going back to as we were. So if you want to vote, we will see what your thoughts are there. Well, I was predicting that we would see almost a split of 33% across each one. So I think what I've just done is sold you the idea of having engines managed by IBA, because we can save some cash. But I think also this does bring up the move towards used material. I mean, Mal, we haven't really spoken too much about PMA parts and DER repairs, but I'll ask you one thing. Firstly, would you expect to see more PMA parts where they're allowed by, if you own the engine yourself rather than at least, would you expect airlines to use more PMA, or do you think the shift would be towards more used material? Have you got any thoughts on that?
Well, I think it's going to be towards used material. The PMA alternative, is good. It's commendable when it's there, but it's a replacement for new material. If the supply of used material in the market is good, that's where people will go, and they'll get an adequate, reduction in cost there, as they would with a PMA part. So I think supply is the key here, and in the environment we're looking at, and in the shop visit projections that David put forward earlier, you are looking at certainly a few more years before the market recovers to normality. So there will be a good supply of used material. That's my opinion. The thing there is, investors in used material and in teardowns will need a bit of confidence that the market is picking up adequately to justify that.
Yeah. If we go to the next slide, please. That sort of discussion about fuel consumption does bring us on to the subject of environment. We do have an upcoming edition. We did publish this report, and it is available, I think, on our website. If not, drop me a line. Aviation and the Environment. We produced this earlier this year in a pre-COVID situation, and then we went on to host a roundtable luncheon at ISTAT in Austin in Texas, and I think that was March the 2nd. So that was our last trip abroad, or at least mine. But we are going to be issuing an addendum to this, because there's been a lot of changes in terms of regulatory policy, and the OEMs have come up with some various changes to their expectation for the future as well. So next slide, please. Here we've looked at the use of sustainable fuel, and this is a projected impact of sustainable fuel. So this is looking at various routes that British Airways are flying, and what their estimates are if they go down the route of incorporating more sustainable aviation fuels. So we've looked at the Heathrow JFK flights, Heathrow Dubai, and the shorter routes, Heathrow to Madrid. And assuming that there's 50% mix between the jet and the sustainable aviation fuel blend, you can see how the savings are considerable. Very roughly, you could see a 33% reduction in terms of the CO2 output as and when British Airways go down this route. On that note, I'll have the next slide, please. And it's the takeaways. I mean, here, I think we're all desperately wanting to hear good news. There's some good news about vaccines. It's going to take a long time before probably your three panelists here are allowed to get the vaccines. We're clearly not old enough, but I do think there's been improvements in the testing. There's been several routes. I think I saw the Atlanta, Amsterdam route, some specific testing going on there. We're expecting to see various airports and airlines come out with initiatives as we come into the new year. I think we've shown that engines do show long-term value retention. That they are, of course, under pressure, but probably not as much pressure as some of the airframes. We've seen utilization improving in a lot of regions of the world, but this sector length decrease, it's currently the information we showed you was on the NEO. I would say that, generally speaking, as fleets of aircraft get older, the sector length does reduce as the longer routes are replaced with the new equipment. But we are expecting this the sector length that we showed on the NEOs to recover once the market picks up. We're obviously seeing continued reduced shop visit projections, and that must be a concern for firstly the engine shops doing the work, but also the OEMs providing the parts into that sector. We do see a lot of optimization of the engine build work scopes coming on. This time on wing versus cash debate that myself and Mal had. I don't think it was too much of a debate. I think, Mal, you did agree that I'd only need to spend $1.5 million out of my $3 million pot. So thanks for that. You've already saved me $1.5 million. That's not bad return on a so far 50-minute seminar webinar. And we are seeing increased attention to ESG considerations. We have had a few questions in, and while I sort through those, I'm just going to ask you, Mal, sustainable aviation fuel, has that been fully tested on engines? Could we see some future issues with sustainable aviation fuels? Could we see lessors limiting the use? I don't want to be a doomsday merchant, but it's in a fast-moving market, aren't we?
Absolutely, very fast-moving, and lots of considerations there for people to think about. First of all, sustainable fuels. There's a variety of different types and sources out there, and if we think back to the influences of having the right fuels and the right oils and engines over time. We have experienced in the past where high sulfur fuels, things like that, did have adverse effects on engines. So sustainable fuels have to be very carefully considered. And to your point, I think lessors will probably want to understand the implications for their equipment if sustainable fuels are used in their aircraft. That said, this whole conversation is only going one direction, and that is towards sustainable fuels. So the business is going to have to understand it better and find workable solutions.
Yeah. Been asked a very general question here, and it's it could potentially open a so-called can of worms, as we call it. The question is, if a lessor takes an engine back and doesn't overhaul it, but it was part of the redelivery condition from the operator, would the operator be able to claim the maintenance reserves back? I'm going to throw that one to Mal, because I know you like this subject, Mal. So if the money isn't spent on accrued maintenance reserves, who owns it? Is it the operator or the lessor?
Well, my guess is it's the lessor, but it's very much down to the individual lease agreement. I mean, the corollary of that is if the maintenance event did take place, the engine would have more value. So the lessor would have a more valuable engine in his hands. So the reserves are there by way of compensation for that loss of value. As we said earlier, there are timing considerations here where that might be more advantageous or less advantageous.
Yeah.
I mean certainly where the aircraft is very marketable and you have another lease in place, you want those engines in good condition. You do want to do that shop visit event and have it out there in the next lease under the correct delivery conditions in that case.
Yeah. David, in terms of some of the engine values, so I've just lost my place on some of these questions, just forgive me a second. I don't know if you can address this one, but what's the impact to market values of narrow body aircraft engines such as the CFM 56-5B, 7B, B2500A5, LEAP 1A, LEAP 1B? So it's a very long question. Do you anticipate engine value to be much more stable compared to that of the corresponding aircraft value? How do you see that one playing out?
Right, so in terms of value, I guess the first thing to address is that when we're providing a market value that does fall under the ISTAT definition of market value, you may see trades today are much below the values that we're providing. Those, in our view, are distressed sales. That's just the first point to put out there. You've named a number of platforms, a number of different engines and aircraft platforms, but really the consistent trend should be that the newer the asset, the more resilient we expect it to be. If you're talking about LEAPs and GTFs, we've seen trades of these during the downturn from the pandemic, and there's been a nominal discount rate, if anything, that's been applied from list price, whereas trades we've seen on more mature assets has been much more significant. In terms of resilience versus the airframe, I think we addressed that quite well in a slide earlier where we compared, it was a 1999 vintage A320ceo versus the 5B4/P equivalent engine. And we see that the engine value has been very, I mean, comparatively at least, very, very stable, has shown a lot more resilience. And now that we're in a softer market, whilst we are, yes, still seeing a mature asset soften in value, which we would expect, it's much less so than the aircraft platform as a whole. So I think a lot more confidence been put in the engines for sure.
Okay, we've got a couple more minutes, and Mal, I seem to ask you the really tough questions, Mal. You're almost wincing already. You don't know what's coming, do you? But the basic business model. I'm going to be very general here and say the engine OEMs. Sort of the theory is that they kind of give away the engines on a new aircraft to tie that airline into the long-term agreements. I know that's a very general statement. Should that change? You know, I mean, we've got a situation now where, you know, some of those OEMs, you know, in particular, you know, you've got sales of new engines plummeting. You've got the engine shop visit side, so the aftermarket MRO part of their business has dropped off this year. Do they just have to correct it and say, sorry guys, you got to pay for these engines on day one? Is there any fundamental change that you could see happening?
Well, I think there will be a change. First of all, because as you say, the business model is based on, you know, selling into the future, and you know, spare parts we're going to, you know, cover up, not cover up, but restore the profit margins to OEMs. Sale of spare parts in the future is a big factor. But also what we're seeing a lot on new aircraft introductions is that there's only single engine choices. So I think the two things together will drive the OEMs towards a rethink on where they need to price their engines. And the engine development is a very expensive business. And when we look at the fuel benefits and the economic benefits of, you know, new aircraft over time, the bulk of the benefits have been in better engine technology. So I would expect OEMs will, you know, want compensation or reward for that going forward. So indeed, yeah, I think that idea where there was 3 engine types available on an aircraft, and as you say, that there were stories out there that they were almost given away, you know, with the aircraft. I think those days may be gone. And you know, the pure investment in a new technology platform is so big that people are not going to go into aircraft where there's multiple engine choices in terms of investment. That's just my take on it at this stage.
Yeah, of course, I can remember conversations in the past as well with some financiers saying that they actually liked the idea of the airline paying the OEM towards the future maintenance, because the very fundamental level, the credit rating of the OEM was always going to be better than the airline. But you know, ultimately, you know, these OEMs are sitting on a lot of cash that is meant to be spent in the future rather than just getting through a downturn. So I think there's going to be some questions. And of course, I don't know why I've focused on some of the things going back a long time, but I can remember, although I think I was at school, you know, Rolls-Royce got in serious trouble with the Lockheed TriStar, the development of the RB211 engine, at a time when, you know, the world was in turmoil with, you know, massive increases in oil price. The development of that engine needed, you know, the OEM to be bailed out, and it, you know, it's a long time ago, mid-70s, but you know, I think this year we found that you know, nothing would surprise us. I have gone on to 4 o'clock here in a rather dark London now, so I'll go through thanking Mal and David for joining. Thanks everybody for joining us this afternoon. So just to say that the data you've seen today is from our online data intelligence platform, Insight IQ. Please do drop us a line or register through the website if you'd like to have a look at the system. Please also get in touch if we can help with anything else that we've discussed today. We've had a lot of questions, and I didn't get round to answering all of them. We had many in before the session. Some we responded to by feeding the answers in through the presentation today. But thanks very much for the questions today. We will be getting back to you all on those questions you've asked us today. So on behalf of IBA, Mal, David, myself, thanks for joining us. Special thanks as always to our marketing team of Mel, Lucy, Dom and Abby for organising us to get these out. So this is the last one of the year. Please do join us next year. I think we've got a market update coming in the second week in January, so keep close to us on there. Remember to vote for us, and if you could please all follow us on LinkedIn. We'd really like to get to the 5,000 followers before the end of the year. I think that's enough begging from me. I will leave you to enjoy the rest of the upcoming holiday season. Goodbye.